private credit remains in the spotlight with redemption limits and liquidity concerns making headlines. So after a trip to London, what's the reality on the ground and how should investors navigate this? Frank Danieli is joining us from MA Financial. So you've just been
Andrew,
to the UK.
good to be back. Yes.
Great to see you.
Much warmer here than there.
Yeah, I'm sure it is. Is the same applying private credit at the moment? How frosty is it?
Well, look, I think that it's a bit of a tale of two cities, to be honest. There's one part of the private credit market that everyone's focused on, and that is sponsor-backed lending, particularly in the US, and especially to those software and technology borrowers. But as a general thematic, people are wondering whether there's been too much money in one space. What I've been hearing from investors all over the world, last week I was in London, I've been in Hong Kong, Singapore, through Asia, is that people are looking for diversity. I think the Australian market, as a general principle, not just for credit, actually does resonate a lot with investors, and in particular in credit, private lending. It's because the ecosystem here is quite broad. Private credit in Australia doesn't just mean lending for one thing, say sponsor-backed lending. It actually means a whole variety of different things. It's basically things that used to be on bank balance sheets, but where the banks aren't the efficient lender anymore. If you think about that whole ecosystem, there's always good and bad, and there's always ups and downs.
Well, particularly in the States, where there's a big focus on tech and AI, and perhaps we know the vast amounts of capex there. So is that where those cracks have emerged?
But that's a really good example, I think, of the tale of two cities. So if you were just lending to a software company that is at risk of either disruption or total displacement by virtue of AI, the so-called SaaS apocalypse, then sure, you could be facing issues. If you've got too much exposure there, and some US BDCs had 22% exposure, some 40% exposures to just one thing, that's not very prudent portfolio management in my view. You should have a very diverse portfolio. But even if you just take that one example, the flip side of AI is that it is going to result in the enormous capex wave that you mentioned. We're going to spend an enormous amount of money on power infrastructure, not only in addition to the physical build of the data centers, things like the water infrastructure, fiber. There's going to be a whole set of infrastructure investment. Businesses that can use the technology are going to need to invest in it, need capex. There's a whole funding wave around digitization, decarbonisation and deglobalisation that you can allocate capital to. That's why you want to have a broad spectrum, because there's always two sides to the coin. The thing we're really thinking about with AI is not necessarily just, do you have loans to software companies? That's, I think, the wrong question. The real question is, and this applies for banks and non-banks, is what's the definition of a prime borrower today? Because the prime borrower, who's the traditional white-collar employee in a good salaried job with long tenure, if they're in a role that AI can replace, they might actually be a subprime borrower now because of AI versus the self-employed electrician who's going to build that power infrastructure or participate in as a subcontractor. They're probably going to do really well. So it's just going to be a changing of the guard. If that happens naturally in markets, it's accelerating because of AI.
So we have seen an increase in the number of private credit funds limit redemptions. Is that leading to panic, particularly, I guess, investors thinking, I can't access my capital, am I going to lose my capital?
Yeah, look, there are two ways to access private credit funds, I should say. So you can get private debt via an unlisted fund. An unlisted fund is always going to have less liquidity than something that trades every day on a stock exchange or trading like bonds in the over-the-counter markets. That's why at least our view is that you want to give investors the option for both. So in Australia, we've got unlisted funds. We also have listed investment trusts. We have those, a series of prominent and high quality managers have both of those options, and it gives investors the choice. If you want daily liquidity by something that will trade on an exchange, that comes with a trade-off. And the trade-off is usually a little bit less return, but also there's going to be more volatility in that because it's all about what buyers and sellers are doing on any given day and more driven by sentiment rather than fundamentals. It's just a trade-off you have to make. So this is not a feature, it's not a bug, it's a feature of these products.
So on that basis, are you expecting those listed trusts are going to be perhaps become more favourable in terms of where investors turn to in private credit?
Well, I think that if you've got a listed trust where there's independent valuation review of the net asset value and it's trading below net asset value, it's a pretty interesting way to get exposure to $1 for less than $1. If you can buy $1 for 98 cents, 95 cents, that's pretty attractive, especially if it's paying you regular yield and you have good disclosure, and you understand what's actually in it, which is critical. If you have those things, I think it's pretty interesting. And that is for the investors that want more liquidity. For those investors that are taking a longer term view, they can participate in the unlisted trust, and they would recognize, especially if they're working with a financial advisor, that they're actually going to have a different profile in terms of their liquidity. It's a longer term hold.
And Frank, what are the existential crisis we're facing at the moment, given energy costs, higher inflation, higher interest rates, and the risk of default?
Yeah. There's always something that causes the risk to default. There's not one thing that others is, if the interest rates rose, then they went down, now they're back up, now there's, you never have a crystal ball to know what it is. Is it going to be something left field like AI? Is it going to be something macro like what you're talking about? In that environment, you are likely to see higher defaults, because if you're going to see higher interest rates, if you're going to see energy price issues, if there's general negative sentiment in the market because people are cautious, then that can cause higher defaults. But default levels at the moment, at least if I think about our book, our largest fund has a 1 to 1.7% loans that are in a workout situation. You've always got 1 to 2% of things that aren't going quite right. We have 243 positions today. We can't get them all right all the time. That doesn't mean you lose any money, by the way. It just means that you need to roll up your sleeves and go in and recover your collateral there, or fix things. But even if you see elevated defaults, everyone's talking about elevated defaults in credit. I think people should step back and say, if the credit is impaired, if you're seeing higher defaults in credit causing loss to the credit, that means the equities are zero. Because if you've done credit right, let's just say you've lent to that software company. If you've lent at 5 turns of EBITDA, and the company used to be worth 20 times EBITDA, and now because of the sentiment around AI, valuation dynamics have changed and it's worth 10 times, you've still got equity behind you. If you're losing your money, someone else, whether it's private equity, venture capital, or public equity, is losing all their money before you, as long as you've done credit right. So yeah, there could be higher defaults, but if you've done credit properly, you should be able to withstand even through those volatile times.